Good afternoon, class. Now, today's class, we are going to actually talk on the second part of money demand and supply. And the topics covered today will be Friedman's restatement of quantity theory of money, monetary base, credit creation, movements in monetary base, monetary aggregates, velocity of money, and its variability. Okay, so let me actually show you the slides for today. Right. So we would start with today with Friedman's restatement of quantity theory of money. Right. We had already studied quantity theory of money in our early class. Now, what happened was the traditional quantity theory of money that was there, it was having the impact of Great Depression. Okay. So and what was the theory? It said at that time that there is a direct and proportionate relationship between quantity of money supply and the price level, right? But during the time of depression, many of the countries did not observe the same thing. It did not happen. So at that time, Professor Milton Friedman, he published a paper called The Quantity Theory of Money, a Restatement. So what happened here again, the concept of the velocity of money, velocity of circulation money was the center of controversy. Why? Because Friedman was not having similar approach as was the opinion of the traditional economists, right? So what in the restatement of the quantity theory of money, what was happening is that what was stated that the medium of exchange function of money, right, is considered still considered as the main function that has to be taken into consideration at the time of talking of the quantity theory of money. So that was what was said. Money, the main function is medium of exchange, and the amount of real income is also an important factor which affects the price level. It also, that's there. Okay, it's along with that, what we also have is the income elasticity of demand for money, right, which is not equal to unity. According to Friedman, it was greater than unity. The income elasticity of demand for money is greater than unity. It's not equal to unity, right? So price level is first of all the amount of real income that affects price level. But there's also something which is there, which here what Friedman had to say was that the income elasticity of demand for money is greater than unity. Okay, it's not equal. So an increase in the real income, that means, will lead to a more than proportionate income in the demand for real cash balance. So that's why it's greater than unity. And the demand for money depends on three major factors. That is the total wealth that is to be held, the price and the return on the type of wealth that the persons have holding, and the taste and preference of the wealth owning class. Okay. So the concept of permanent real income. A permanent real income, what is permanent real income? It actually refers to the total amount of income which an individual is enjoying during a given period, which does not have any effect on the reduction of his wealth. His total amount of income which he is enjoying during a particular period, but which does not have any effect, which does not lead to the reduction of his wealth. So when we talk of permanent real income, it is what we are talking. In other words, we are talking of the concept of wealth. So as per Friedman, there are 5 broad ways to hold wealth. One we know is money, which is money is where you hold the purchasing power for buying goods and services, right? And for discharging of the debts and obligations. Second type is bonds, which gives us interest. Third is equity, So where we have a perpetual income in the form of dividend. Perpetual is continuous. Physical goods. Physical goods is it could be movable or immovable assets, which is also a source of income. And human wealth. Human wealth here, where we are talking of the skills, the training, production efficiency of an individual. So, as per Milton's uh, equation of quantitative theory of money, M by P is the amount of real cash balance. It's equal to function of Y. Y is permanent income. Now M by P, M we know is the money stock, P is the price level. Y is permanent income, W is the ratio of non-wealth to human wealth. RM is the expected rate of return on money. RB is the expected rate of return on bonds. RE is the expected rate of return on equities. And 1 by P dPdt is the expected price appreciation or depreciation, which in other words, it talks about the expected real return on assets. U stands for all other factors except income. So, what are the basic features of Friedman's theory? First, it talks about the conceptual integration of income and wealth, where it says that wealth is a means to earn income, and the Friedman has given a special emphasis on human wealth, right? If more skilled a person, he or she will be earning more. So that we already know this, right? Second concept is the concept of permanent income, that is expected yield on wealth. So demand for money is function of permanent real income. Thirdly, money has been used in a wider sense. As previously we had included currency which is on hand. So here, what we have not just currency but demand deposits and time deposits are also included. The fourth thing that comes up here is, as per Friedman, to have price stability, the supply of money should increase slightly more than that of growth rate. And what happens is, when there's an increase in money supply, it leads to an increase in the aggregate demand for goods and services, which in turn leads to an increase in the job opportunity. So increase in employment, which leads to decrease in the rate of unemployment, and which ultimately stimulates economic growth. That's in the short run what happens. But in the long run, what happens is this increasing demand will some point will be much more greater than that of the money supply. So which causes a disequilibrium in the economy, and this shortage will be caused by a greater demand than supply. This shortage will ultimately force the prices to go up, leading to inflation. So supply of money should be increasing at a greater rate than that of, slightly greater, not too much, but greater than that of the growth rate. And the next point is, like in the cash balance approach, only cash balance or the bank's cash reserve was the main factor that was taken into account. But here what is happening, all types of assets are taken into account. Okay, so basically, what are the limitations of the theory? There are some limitations here. So firstly, it says that it's advisable to include time deposits. It's not advisable to include time deposits in when we talk of money, because time deposits, it's very difficult to withdraw, right? And what happens if you withdraw before the given time span? You will tend to lose interest. Sometimes you have to pay some penalty. So it should not be treated as new money. Second limitation is that Friedman neglected the effect of rate of interest on the demand for money. Okay, as was done by all other approaches. Thirdly, the assumption that money supply is independent of the changes in price level and income is not correct. Money supply is not independent, right? It depends. It is related with the price level and the income. Okay. Fourth, Friedman's theory cannot be stated as a restatement. Why? Because he presented the general approach in his own words. There was nothing new in that. It's just his opinion. Fifthly, the ratio of non-human wealth to human wealth and the other factors than income, that is W and U, they are subjective in nature, so you cannot measure them, right? Ratio of non-human wealth to human wealth, it's very difficult to measure, and all other factors other than income. So it's very difficult to measure, right? It's very subjective. It depends on the person to person, how you're perceiving it, how you look into it. And the sixth one is like it is difficult to keep the steady state of money supply in the modern and dynamic economy. It's very difficult because things change every moment. It's changing, so steady rate of money supply, it's very difficult to maintain it. Okay, coming next topic that we have is monetary base. Now, what is monetary base? Monetary base is when we refer to the amount of cash which is circulating in the economy, right? To amount of cash. So it's divided in two parts. One is currency in circulation. The other is the bank reserves. A currency in circulation is basically with the bank notes and coins which is held by public, which we use for our day-to-day life. Whereas when we talk of bank reserves, these are the cash deposits that all the financial institutions are holding in their accounts. So but it's the total, it's money in circulation as well as one deposits. It's the monetary base. So what's the importance of monetary base? Central banks can increase or decrease the monetary base through different forms of monetary policy. So for instance, for many of the central banks, the monetary base is increased through the purchase of government bonds, which is also known as open market operations. Right now, open market what happens here when the central banks are purchasing bonds from the commercial banks. So what the central bank is doing, they are replacing all the illiquid bonds with the cash deposit in the bank's reserve account. So when they're purchasing it, what happens? There's more money in the hands of the commercial banks. So what basically when we say is open market operation, when we say what exactly is open market operation? Open market operation is where the central banks are purchasing or selling securities in the open market to regulate the supply of money that is on reserve in commercial banks, in reserve in with the commercial banks, and thus the which is available as loan. It's available to give as it's available with the central banks, which are to give out as loan to the businesses and consumers. Okay, so when we talk of open market operations, it can be either expansionary or contractionary. That is when the open market, when expansionary open market operations is where the central banks are purchasing the securities to increase the money supply. So it becomes easy for more money in the hands of the commercial banks. So it's easy to give loans, more money, more people can get loans. So it's easy to get loans. So there is an decrease in the rate of interest, more money. When there's more money means there's decrease in the rate of interest. Whereas on the other hand, when we talk of contractionary open market operations, that is when the central banks are selling securities to the central bank, to the commercial banks, and to reduce the money supply. So what happens? Less money in the hands of the commercial banks. So loans become expensive. Few people can get loans, and it's not, even if people are getting less amount, and so the less amount of money supply means there's an increase in the rate of interest. Okay. Okay. So central banks can also increase the reserve requirements. What is reserve requirements? Which is the requirements on how much cash banks can keep in the reserve accounts. So by increasing the cash supply, market rates will increase. When you decrease the cash supply, market rates will increase. Increasing of cash supply, decrease in the interest rates, and decrease of cash supply will lead to increase in the market interest rates. So what happens is, by adjusting the monetary base, is one of the tools that central banks use to modify interest rates. And by using the monetary policy to maintain the monetary base, central banks also ensure that the steady state supply of cash is always available for use. So it's a central bank which actually controls and monitors how the monetary market is running, and they control accordingly as and when the situation demands either increase the amount of money supply in the market or decrease. Okay, next comes up is credit creation. Credit creation, what is credit creation? It's basically when we are talking of a situation when a bank may receive interest by, by permitting customers to either overdraw their accounts or purchasing securities or paying for them with its own checks, right? So which helps in increasing the bank deposits. So bank credit means also like here when we talk of bank credit, it's talking of the bank loans and advances which the banks giving credit, giving loans. So that helps in increasing the amount of money. So that's and how, because the banks are getting an interest. So what happens is, bank keeps a certain portion of its deposits as a minimum reserve to meet all the demands of its depositors, and lends out the remaining to earn income. So certain portion, banks doesn't keep the entire cash on hand, like a certain amount as reserves, rest is for lending out to earn income in the form of interest. So the loan is credit. What happens when we as customers, when we take loan is credited to our account, right? And what happens when we have a loan? So there will be an equivalent deposit in the bank. If we take a loan of say 25,000 new term, that amount is credited in our bank, and which actually what happens, like it ultimately will lead to an expansion of the bank's deposits. Now how does this happen? Let's go into this now, right? So there are two ways. There are basically two ways of analyzing this credit creation process. Two ways it can happen. Credit creation can happen by a single bank. Credit creation by banking system as a whole. So in a single bank system, what happens is, one bank operates all the cash deposits and checks. And how is it done? Let's look into the next slide. I have an example for you. See this is this chart where what happens. Let's suppose that the bank requires to maintain a cash reserve ratio of 20%. So if a person, say person A, deposits 1,000 rupees with the bank, so bank keeps 200, that is 20% of 2,200 with them, with the bank as the cash reserve. And what happens? It lends the remaining 800 to another person. That's what it does. You deposit 1,000 rupees, it's there, that coins to your name. But what bank does is they keep 200. It's 20, because 20% is the cash reserves ratio. 800 extra gives to another bank, another person, second person. Now, second person, what happens? Second person is getting 800 against their name in their account. But what happens? Bank keeps 20% of this, because 160, and the rest is given out to the third person. And that's how the process goes on. It goes on until the entire amount of money is being given to different people, different for loans, and it's that's how, and the money keeps on rolling. So if you actually see what happens, this process continues till the initial deposit of 1,000, right? And it's totally exhausted. It goes to different people. So if you start adding up, right? So you start adding all this. What is it? The total deposits that you find is 5,000, which is there, and credit that is created is what happens with this initial deposit is 1,000, and the total amount of credit that comes up is 4,000 if you start adding up the entire process. So it goes on, and the total amount of deposits that the derivative deposits that the bank is getting is through the credit creation is 4,000. So that's what it happens. Total initial, like that's how it goes on. Okay, with an initial deposit of 1,000, total amount of credit created is 4,000, cash reserves is 1,000. So the total deposits with the bank becomes 5,000 if you just add up. 1,000 goes to 5,000, out of which 1,000 is the in cash reserves, 4,000 is the credit creation. So that's how it goes about. So what happens in other case, like in this case, what happens? The credit multiplier, right, is 5. That is, and the total credit creation is 5 times the initial excess reserves of 800. 5 times. So 5 into 800 is 4,000. Initially, it was 800 in reserves that was given. So from it, 5 times it becomes 4,000. That's how banks create, like that's how the credit is created and banks earn money. Okay. Now what happens is the second case when we have multiple credit creation by the banking system. So in this case, the banking system has many banks, and it cannot grant loans in excess of the cash that it creates. So when a bank creates a derivative, account, what happens? It loses cash to other banks because you are. But the process is the same again. So what happens? Like you giving money to one person, right? So and the person uses it and goes and deposits into another bank. So one bank when they create this deposit account, the derivative account. So what happens? This money goes to when you're giving loan to another person, they go and deposit in another bank, and so multiple banks. So one bank loses money, it goes to the other, but the total amount of money in the economy is the same. The process is the same, but it's same as single. When you have the single banks credit creation by a single bank, and multiple credit creation system, it's the same. Only thing is, in case of single credit creation, the entire amount of the money that you have, the deposit, it lies with the same bank. But it is in case of multiple credit creation, it doesn't it's not in the hand of the same person, same bank, but the total amount is the same. So the loss of deposit of one bank is the gain of deposit for another bank. So the transfer of cash happens within the banking system. So it creates primary deposits and also increases the possibility for further creation of derivative deposits. It goes on. It's the same thing, but it is received. It's not kept with the same bank. That's the difference. Otherwise, it's the same process. Okay, now what happens is it's generally understood that the money which is received by bank is meant to be advanced to others. That's what we know. Banks have money, they give it as loans, and the depositor has to be content simply with the bank's promise or undertaking to pay him back when he makes a demand. So if you deposit money, what happens? Like at some point, if you want the money back, that's it. Banks have to give you back. Right. Now what happens? Banks is able to do with a very small reserve. Why? Because all depositors do not come to withdraw money simultaneously. Some withdraw, some will deposit at the same time. So what is happening? Bank is able to create a vast superstructure of credit on the basis of a small cash reserve. We just saw that. Small reserve, they're lending it out, earning interest, and there's always that risk that the depositors would want their money back, but then everyone doesn't want it at the same time. And when some are withdrawing, some are depositing, so the banks they know how to balance it, that keeping that minimum amount as reserve rest into it, and they earn interest. They lend it, and they lend the money and charge interest. without actually parting with the cash. When banks are lending money to customers, so what happens? The money doesn't actually go like at the it's only transferred to the account, but it stays with the bank, and the interest is the banks charge interest, so they're getting that. And when the money is returned, they get it like actually gets transferred back to the bank's account. They also have to the bank's deposits. There's also an interest which is also added up there. Okay, so money actually doesn't go out of the bank. It's just a transfer of account within the bank. Okay. Uh, so what happens? Similarly, the banks can buy securities and pays the seller with its own check, which again is not a cash, right? It's just a promise to pay cash. And this check is deposited maybe in the same bank or in some other bank, and a deposit account is created, credit is created for the seller of security. So that's how it goes. Take the account. You may not deposit in the same account, same bank, the check that you get. You go and deposit another account. So the seller doesn't get the seller of the securities, and they get that check, right? They get the check on hand by the bank. The banks don't give money. So and they go and deposit the check to another bank. So what's exactly happening? Money is not actually literally in the real sense being transferred from one account to another. It's not going that way. It's just a internal within the same banking system, just a transfer of accounts. The cash doesn't move, but credit is created. Credit creation happens. This is the second case. This case is where we talk of a multiple credit creation system. So it goes on. Loss of one bank is gain for the others. So it's within that system that happens. Okay. So the two most important aspects of credit creation. One is liquidity. Liquidity, where what does that mean? That's the bank must pay cash to its depositors when they want to, like when they have a demand for cash against their deposits. Like they have deposits, they want to withdraw, so banks has to pay cash. That's one thing. Second thing that talks about is profitability. So banks, we all know they are profit-driven enterprises, right? So bank must grant loan in such a way which would earn more interest than it pays on its deposits. So when deposits are there, the interest the interest that the depositors are getting, and it should be lesser than the interest than that the banks are charging on the loans, because the rate of interest on loans given is higher. That means banks are earning more money, and with that they have more money on hand, and then it's easy for them to actually pay the depositors when interest on the deposits. So they're earning from there. Otherwise, if the loan interest was much less, the banks would have earned much less, and there would be insufficient cash to pay for the interest on the deposits. So banks' credit creation process it's based on the assumption that during any time interval, only a fraction of the customers actually need cash. And also what bank assumes is that all of its customers will not come up at the same time asking for cash against their deposits. So that's it. Like only few would actually ask for a cash withdrawal, and not everyone would ask for it at the same time. So the basic concepts of credit creation. Firstly, we have is where banks are considered as a business institution. Bank is a business institution whose main purpose is to maximize the profit with the help of loans given and also advances from the deposits. Second is bank deposits. Now, bank deposits they form the basis of the credit creation, as we just explained, right? And our bank deposits can be two types. One is the primary deposit. The second is the secondary or derivatives deposits. Now, when we talk of primary deposits, what are primary deposits? Primary deposits, it's basically where a bank accepts cash from the customer and opens a deposit in his name. Like when we go and deposit money, we open an account, right? So this is primary deposit. So, but this does not mean that credit creation. These deposits simply they convert the currency money into deposit money. The customer is having currency in hand, it's been deposited. So currency money gets converted into deposit money, and this is but this deposit money forms the base for credit creation. It forms the base, but it's not credit creation. Secondary or derivatives deposit, where a bank grants loans and advances, and instead of giving cash to the borrower, what happens? Opens a deposit account in his name, account, and which is the secondary or derivative deposit. So just opens it. Cash is not given. It's the account is there, and it's said that the money is transferred, but money is with the bank actually. And this is the this loan that is given to the borrower. It creates a deposit, and this creation of a derivative deposit means this means the creation of a credit, because from there a part of it is given to the next person, so that process goes on, and interest is earned from these deposits. Interest, banks get interest, so credit is earned. We explained it earlier. Third concept is the cash reserve ratio, or CRR. Every banks know that all depositors will not withdraw all the deposits at the same time, right? So what the banks do, they keep a fraction of the total deposits for meeting all these demands of the depositors, cash demands, that when if they want to withdraw money, and lend the remaining excess deposits as in the form of credits, right? So cash reserve ratio it's a total percentage. It's a percentage of the total deposits which the banks must hold. Okay, it is mandatory. They must hold in cash reserves for meeting the demands of the depositors when they ask for cash. When they meet, or in other words, demand for cash. Depositors demand for cash. Fourth is excess reserves. Now these are the reserves which is above the cash reserves. That's when the banks have excess reserves which is more than the cash reserves. That's excess reserves which is used for loans and credit creation. Fifth one is when we talk of credit multiplier. Credit multiplier. So what happens? I just explained to you a while ago, either through single credit creation system or multiple credit creation system, that with a certain amount of cash, bank can create multiple times credit. So in the process of this multiple credit creation, what happens? The amount of derivative deposits that a bank creates is it's multiple of the initial cash reserves. We just saw that, like if 1,000 and 800 was the reserve, and from there it becomes 4,000. So 5 times it goes on, right? The total amount of derivative deposits, so it increases. So that if you refer to the example. Okay. Now, so coming up is what are the limitations that we have, limitations on the powers of banks. There are some limitations with the banks when they create credit. Lack of securities, business environment, lack of cash, habits of the people, leakages, and central bank's policy. So let's go into details. First is lack of securities. Lack of securities. Now, securities, what is it? We are talking stocks, shares, bonds, right? So what happens up here is securities is what it helps, it transmutes other forms of wealth into money, right? When you have securities, right, banks have, so it helps. So other forms of wealth is when we talk of stock, shares, and bonds. So that can be converted into money. Banks cannot they cannot expand their deposits by giving grants or advances until and unless proper securities are available. That amount of money should be there with the bank. Then only can they lend money. So the total volume of income yielding securities available in the country, that is sets a limit to the total process of credit creation. How much credit creation can happen? It is determined by the total amount of securities. Second is bank environment, the business environment. Now, loans are taken when there's a good opportunity, investment opportunities are available. In times of recessions or depression, what happens? Deposits tend to go down. Why? Because people would want to hold money on hand, right? So the business situation of the country is also an important factor, which determines the volume of credit. Third comes up is lack of cash, right? The total amount of cash available in the banking system, it also sets a limit in the volume of credit that can be created, because credit is based on the cash that is available, and banks has to keep a certain percentage of cash reserve, right? The total volume of credit, it cannot be more than the total amount of cash which is available, uh, and cash available and multiplied by the customary reserve ratio. So it's the total amount of cash into the customary into the reserve multiplied by the reserve ratio. That gives you the percentage of the amount of reserves that the bank has to have. So anything extra than the bank has to give. So it depends the total amount of cash, how much cash is there. So that determines the cash reserve ratio, and the remaining goes as for credit. So if the reserve if the after keeping if the total amount of cash is less, then what happens? Less amount of money can be given for credit purpose, because banks have to keep a certain amount of money, of that total money, for as their reserve. So what happens is, in what we find is that the banks, central banks, they cannot they control credit by who they're the ones who are controlling all these credit through measures like, as we discussed earlier, open market operations, through the variations in the reserve ratio. That in turn affects the quantity of cash which is held by quantity of cash available by the in the hands of the central banks, in the commercial banks, and thus it also influences the total lending policy, right? If the amount of cash in the hands of the central bank in the commercial bank is more lending. If it's less, it is less amount of loans is given, so it becomes difficult to get loans. Okay. Habits of people, the fourth point. Habits of people. Now people, like, what happens, like how the habit, in the sense of habit with regards to holding of cash, right? So when liquidity preference increases, then what happens? People are holding more money, so there'll be less amount of cash in the hands of the bank. So they'll, and the amount of loans that that they can give, the banks can give, is becomes less. So especially, you know what, in the underdeveloping countries which have an underdeveloped banking system, people prefer to hold cash because banking system is not developed, right? Then it's much easier to get keep on cash than to keep in the bank. So what happens? And that reduces actually the power of banks to create credit. Fifth is leakages. Now what happens is, in this the deposit creation, the entire process that we're talking about, there may occur some leakages in the sense is, some of the borrowers may want to keep a portion of their money in hand without keeping it in the bank. So what happens? The total volume of deposits that can be kept in the bank is much lower than the possible maximum amount of deposit. So it goes down. Sometimes it also happens like where a particular bank in that entire banking system may want to keep a higher reserve ratio and lend less. It's not that the central banks are saying so, whatever the central banks say, but these banks want to keep a higher reserve ratio, want to keep some additional amount of in the reserves for various reasons, and so it becomes less in that sense. The amount of money lent into the for credit purposes for loans becomes less. Uh, the next that comes up is what we talk about is the central bank's policy. These policies regarding the open market operations, right? This is one of the policies which affects the total cash reserves of the banking system we've explained earlier, and it also makes the total created credit either less or more than it would otherwise be. It all depends on the central bank's policy. Sometimes it increases, sometimes the credit amount of credit given is higher, sometimes it's less. So otherwise in a normal situation. So it depends on how the central bank wants to go about credit. Okay, the next topic that we have is what we talk is the movements in the monetary base. We've discussed monetary base. So banks lend to what do they do? Banks lend money to any customer who is trustworthy, credit worthy, right? Where banks do have a check before everyone cannot get loans. They would check with the customer's assets and whether the customer can actually repay back the loan, and they keep some assets as mortgage, and only after verification would they give it. And what happens? So they would first lend money to any creditworthy customer that they find, and then they think about their reserve positions later. First, they would give money. Why? It would help them to earn interest, right? So if they are short of reserves, right, then what happens? Then they can borrow from the other bank, from some other bank, or the banks borrow from each other. That is interbank transactions. Okay, or they can also sometimes borrow from the central bank. Central bank is either from other banks, other commercial banks, or from the central bank. So there's a movement happening, right? So an increase in the monetary base, what happens? It leads to a higher in proportional increase in the overall money supply, increase in the total base. So this is because what happens if banks see there is an increase in the deposits, they can lend out a higher or a greater amount of money. They can do that. They can actually lend a greater amount of money and keep the same proportion of in reserve. So if they have more money, so what happens at that time? What do they do? That's like if banks find that there are really some credit good customers, they give loans, and then they look into their reserve ratio, reserve amount, reserve cash that they have, reserve, and if they feel that there is a shortage, then they borrow from some other banks, commercial banks, or they borrow from central banks. So what happens? They have more money now, so more money means they have been able to create, they have more money on hand, and they have been able to create, they are able to generate more interest, right? Because they've already given uh, a portion of the initially from their reserve ratio, they have given already a portion to some customers. They've borrowed, so they have the reserve ratio as constant. Now that portion which is given to the customers, that it's more than what they would have otherwise got it, otherwise given it. So what happens from there? Through the credit creation process, they earn huge amount of money. So they then that's how it grows. So increase in that monetary base leads to a proportionate increase in the more than a proportionate increase in the total amount of money supply. That's how they go. So that's broad money. Like overall, it's increase in the overall money supply. Which is overall money supply is the broad money, right? That's how banks do it. So they increase depending on who the customers are. In other words, okay. Monetary aggregates. What is monetary aggregates? It's basically it's a formal way of accounting for money, such as money here means cash or money market funds. So its monetary aggregates are used to measure the money supply in an economy. And this basically the monetary aggregates. These are basically compiled by the central banks. How on the they do a survey of the monetary and financial institutions. When the central banks they measure that amount of money circulating in the economy, and that's how which is presented as the end of the month at the national currency stocks series. That's how the total amount of money in circulation. Now, what is the impact of the monetary aggregates? Now, if you study the monetary aggregates of of a country, it helps us in giving a clear indication of the financial stability of the economy, financial stability, and the overall health, economic health of a country. So if monetary aggregates grow very fast, total amount of money goes on increasing very fast, it can lead to there's a possibility of inflation happening, right? Uh, if there is a greater amount of money in circulation, then what is needed to pay for the goods and services, what happens? Prices will rise. So what happens if there is increase in money supply more than the in growth in the real output, that causes inflation. So there is more, that means what exactly happens up here, there is more money which is up there in the market, which is try, and the demand is less. Like demand is the limited amount which is there, but there are more money in the hand of people who are trying to actually get avail those the limited quantity of goods. So which actually leads to an increase in the demand for money, increase in the money, more people want to buy it, so the demand for money goes up. So which actually forces firms to increase their prices. Okay, so that's what happens when you have limited amount, same amount of goods and services. It's limited, same, more money in the hand of people, so more people would want to purchase that limited amount of goods and services. So demand goes up and prices will go up. So if there is an overinflation, what happens? Central banks may be forced to raise the interest rates. Force the interest rates means then what happens? People would start prefer to hold less money. They would prefer to invest less, hold money. They would prefer to go and invest in bonds. So the amount of money goes down. Or sometimes, or they stop the growth in the money supply. Stop the growth in the money supply. They do that. Central banks do that. Some they are forced to either raise the interest rates or stop growth in the money supply. That's how it goes. It depends on the situation, the total amount of money in that economy. What is the total amount at that situation at that point? Accordingly, central banks work around with their policies. Okay, so we go to the last topic, that is velocity of money and its variability. Right? Now, what is velocity of money? Velocity of money it's a measurement of the rate at which money is exchanged in an economy. Rate. So it's a number of times the money changes hands, that moves from one person to another. So it also talks about like how much one unit of a currency is used in a given period of time. Within a certain period of time, it how many times how much it's been used. Like it depends on how the number of times it's changing hands. It's moving from one person to another. So 10 people are using it to goes from one person to another within a certain say in 1 month's time. 10 people, it's gone into 10 people's hands. So it's the velocity is what that tells. It's the rate. It tells us actually that money is being used, like it's frequently being used. It's 10 people have used it. It's a number of times, 10 times. The money is being used, like it's been transferred from one person to another. How many times it has moved from one person? 10 times, 10 different people, 10 times, right? In other words, what it's talking about, it's the rate at which consumers and businesses in an economy collectively spend money. So more amount of money is spent means the velocity of money is increasing. The number of time the money is changing hands, it's increasing. So velocity of money, we know that, which is mv, from the equation that we had, the quantity theory of money, mv is equal to pq. So v is the velocity of money, v is equal to pq by m. So m stands for the money, v is the velocity of money or the rate at which people spend money, p stands for the general price level, and q is the quantity of goods and services produced in that economy. Okay, now velocity of money is important. It is important for measuring the rate at which money in circulation is being used for purchasing of any goods and services. Now, high money velocity, when is, what does it talk? It reflects that the economy is in a healthy situation and it's growing. Whereas low money velocity talks, it implies that there's a recession and contraction in the economy. So economies which have a higher velocity of money, it's as compared to the others, tends to be more developed. Developed economies have a higher velocity of money in developed economies. So velocity of money is, it also fluctuates with the business cycle. It fluctuates, right? Where, how, and then economy is expanding. What happens? Consumers and businessmen, they have a tendency and they to spend more. So spending more means the velocity of money increases. On the other hand, when the economy is contracting, what happens is both consumers and businessmen, they would usually want to keep money on hand. They're more reluctant to spend the money. The velocity of money decreases. And so what we see that velocity of money is related with the business cycle, right? So it is not along with the, it's really velocity of money is related with the business cycle. On the along with this, its velocity of money is also related with some key indicators of the economy. What are these? Uh, these key indicators are, say, for instance, the GDP, the inflation, right? So what happens is when there's the increase in the GDP, or when there's inflation in the economy, so what happens? The velocity of money starts increasing. On the other hand, when we have like when GDP or the inflation of an economy, they are falling, right? Especially in a contracting economy. In that case, the velocity of money also starts decreasing. Okay, so that's all that we have here. Okay, so we'll see you in the next class. That's all from here.